Hello and welcome to week 4 mini lecture. This week we review the 4 market structures: perfect competition, monopoly, monopolistic competition, and oligopoly. We're going to spend most of this time in perfect competition because this lays the foundation for what we want to look at this week. But we'll also look at the other market structures too, and we'll see how, based on your market structure, that can influence what your pricing and output decisions are. But first, just start off with the idea of perfect competition. If you look on our beginning of our chapter 14 there, they have the characteristics, and with perfect competition there are many firms in the market, it's a homogeneous product, there's easy entry and exit in the market, technology is available to everyone. So the idea is that you're pretty much a price taker in perfect competition. Now if we look on page 320, in the top of the page there, it tells us that we have both the market and the individual firm. Think of the market as where, say, the price of wheat is established. You have the millers that demand wheat, you have the farmers that supply the wheat, but there's an agreed upon price in the market. If you go to the Kansas City Board of Trade, you can look and see what the spot price or the going price for wheat is. And there's someone trying to project what that future price will be. Well, in economics we call that equilibrium, but in their market typically they call that price discovery. It's opinion of what someone thinks the price of wheat is going to be 3 months from now. But knowing that we are a price taker in this market, we face a perfectly elastic demand curve. If you look at that demand curve on page 320, you'll know it's a horizontal line. So it says if the price changes just a little bit, all buy nothing at all. It's extremely elastic. And because of this, that's the reason we're a price taker. Now with perfect competition, the demand curve and the marginal revenue curve will be on the same line. Marginal revenue, by definition, is the change in total revenue divided by the change in quantity. So with perfect competition, if the price of wheat is $5 a bushel, that means that each bushel I sell, I'm going to get an additional fee of $5 each time. All right, if we look at page 321 and over to page 322, this is kind of the golden rule, if you will, for this week. This applies for monopoly, perfect competition, monopolistic competition, is that when marginal revenue equals marginal cost, we're going to maximize profit. Again, thinking back the idea of wheat, if I sell an additional bushel of wheat and I get $5 and that additional cost was $4, in theory I'll continue to do it. Next bushel will cost me $4.50, I'll produce that because I got additional $5, the difference 50 cents in revenue. At some point, if I produce another bushel of wheat and my cost is $6 and I only get $5, well, I'd want to stop doing that because I'm not maximizing my profits. I might be making a profit, but I'm not maximizing a profit. And if we look on page 324 there, we can actually see the examples walking through the textbook where the difference between, or the maximum profit at $81 at 8 units of output. It's saying that if I would continue to produce, I could make a profit, but we're not maximizing the profit beyond that point. And on page 325, they give us a nice breakdown of what we looked at last week. We're looking at those costs relative to my price and output, and how much profit did I make. Now, the last thing to wrap up with this chapter of perfect competition, we'll go through the 4 scenarios, if you will, for where the firm is, the price relative to the cost. In the examples on page 326, the first example says that the price is at $35 and the average total cost is at $25. Well, anytime the price is greater than average total cost, you're doing really good. You're making what we call an economic profit. That is, you covered all your explicit and implicit and you're doing above and beyond that. Well, we would expect competition to move in at that point and eventually the price would drop. Think about the supply curve in the market shifting to the right and lowering the price. If the price is exactly equal to average total cost, we are earning just a normal profit. That is, we covered both the explicit and the implicit cost. Now, if our price is below average total cost but above average variable cost, we're going to continue to produce in the short run. That's because the difference between those cost curves, you remember from last week, was average fixed cost. So we want to cover at least some of those fixed costs and hope that something changes in the long run, that the price goes back up and we figure out a way to reduce cost. Once you get to the point where you're at average variable cost, we could say below average variable cost, you're actually making yourself worse off. And this is what we call a shutdown point. And this might be examples of a bankruptcy. There's some firms out there right now that I can think of that they're deciding to shut down stores, or they're shutting down their business. I think Borders right now is one in question. So if you can no longer have a price that meets your cost, that's kind of said, well, our investors, the opportunity cost, we need to do something else. All right, on to monopoly. The nice thing is some of the things that we learned in perfect competition, it still applies in monopoly. The big difference, though, is that our demand curve and marginal revenue curve are not the same. The demand curve is downward sloping. We're going to have a marginal revenue curve that is derived from that demand curve. But those rules about where we maximize profit are still going to apply. So marginal revenue equals marginal cost, again, to maximize profit. If we look on page 342, they kind of highlight the difference between a monopoly and competitive firm, in the sense that if it did have to act like a competitive firm, we'd have a much lower price and a greater quantity in the market. You have to remember, monopoly, there's only one supplier in the market. But as a result of being monopoly, we don't have to worry about any competition moving in the market. Now, we do have some markets that are monopolies that are regulated. Typically, utility companies are good examples of monopolies because the government deems them to be a natural monopoly. And imagine what your backyard would look like if you had 10 different gas companies and gas lines running everywhere in your backyards. Well, it just makes more sense to have one company. And with a natural monopoly, economies of scale or low per unit cost are the justification. One other thing I want to point out in the chapter monopolies deals with price discrimination. And essentially, to have price discrimination, you have to be able to segment the market. You identify individuals by age, might be the time of day, and also the inability to engage in arbitrage or resell the product. So if you can get the Wall Street Journal at a student discount rate, there can't be a way for me to turn around and try to sell it to someone else. So price discrimination in general, it can be practiced. Whether you ask an attorney whether it's legal or not, well, they'll tell you the situation, it depends. But there are firms that give discounts for volume. And we do see in the marketplace, whether it's a coupon or giving a discount to a senior citizen, in which firms engage in price discrimination, really in order to maximize more profits. That is, they're charging a different group a different price based on their elasticity demand. Our last thing I wanted to talk about this week is our last chapters with monopolistic competition and oligopoly. Monopolistic competition, you look at some of the characteristics there in the beginning of the chapter. It says they have many sellers, a differentiated product, multiple dimensions of competition, and easy entry of new firms in the long run. Monopolistic competition is probably the most prevalent type of firm out there. I like to think of the fast food restaurants. They produce cheeseburger, french fries, and a soft drink. And maybe each firm does it slightly different, but they engage in a lot of advertising. And they try to convince you that they're doing it better than everyone else is. So, big difference with monopolistic competition. We're not going to be at a minimum average total cost. In fact, if we kind of look and continue on page 365, they point that out. It says in the long run, we're going to get to the point where price is exactly equal to average total cost. You're just making a normal profit. But that is greater than the point of marginal cost equals marginal revenue. So again, in the United States, we like product differentiation. We like choices. So if it was the same hamburger, same french fries, same soda everywhere we went, that would be more like perfect competition. But by engaging monopolistic competition, we have many choices. Last, with oligopoly. This is where the marginal revenue, marginal cost rule doesn't necessarily always apply. Big difference here is we are making our decisions on interdependent decisions. You read about in the textbook about implicit collusion, why a market exists the way it does, or why firms do things a particular way. One example I can think of is hotels sharing information about vacancy. There's no requirement that they share information with other hotels, but it's probably in their best interest that they do share so they know how to adjust price and the quantity demanded. And lastly, with oligopoly, later in the course, we'll look at other things such as Nash equilibriums. We'll also look at the competitiveness of markets, and whether oligopolies can act together to work more like a monopoly. So I want to just give you a summary, some insights for this week. So again, if you do have any questions, just make sure to send me an email. But I hope you have a great week, and that is it for this week. Thank you. Take care.